Welcome to the Pro Ticker Deep Dive.
Glad to be here.
Today we're staring down what might be the most fascinating, frankly, the most contradictory moment in modern history.
Oh, absolutely.
Because it's early 2026, and we are living inside this massive paradox. On the one hand, humanity is currently experiencing the single greatest digital and computational leap we have ever seen.
Right, driven by the absolute industrialization of AI.
Exactly. But on the exact same day, in the exact same world, our physical reality is throwing up these incredibly massive, almost archaic roadblocks.
Yeah, we're talking about severe global memory shortages and geopolitical choke points that are literally shutting down global shipping lanes.
It's wild. It really is a collision of two entirely different centuries.
It is. You have 21st century digital ambitions, these dreams of infinite compute and flawless algorithms slamming face first into 20th century fiscal constraints.
Like the width of a shipping canal.
Or the limits of a local power grid.
Which is exactly our mission for you today. We're going to explore the absolute explosion of the agentic AI era. We're going to unpack the dense, mind-bending technology driving this revolution.
Down to the actual system architecture.
Right. And then we're going to take a hard, objective look at the market valuations that have everyone debating whether we are in a historic tech bubble.
Because that's the question everyone is asking.
And finally, we're going to examine the fragile, incredibly vulnerable physical supply chains that threaten to bottleneck this entire digital revolution.
Because if you want to understand how to navigate this collision of limitless digital potential and harsh physical reality, this is your critical briefing.
Yeah, because right now, understanding the software or the silicon isn't enough.
To really grasp what is happening in the markets and the economy, you have to understand the logistics networks, the energy infrastructure, the raw materials.
All the stuff that actually makes that technology possible.
Right. If the physical supply chain breaks, the digital revolution stalls. It is literally that simple.
Let's start with the sheer financial gravity of what is happening in the semiconductor space. We need to ground this conversation in the actual numbers because, well, they dictate everything else.
They do. The numbers are staggering.
Looking at the latest data for the fourth quarter of fiscal 2026, the financial metrics they just force you to recalibrate what you think is possible for hardware manufacture.
Yeah, recalibrate is a good word for it.
We are looking at a single quarter revenue of $68.13 billion.
That's massive.
Just to put that in perspective for you, there are major global airlines and legacy automakers that don't do that in an entire year. And the wildest part of this data...
The data center revenue.
Yes.
Yeah.
A massive $62.33 billion of that came solely from data centers.
That data center figure is the smoking gun of a complete paradigm shift.
How so?
It tells us that the global economy is reallocating capital at a pace we honestly haven't seen since the build-out of the early internet infrastructure.
Or maybe even the electrification of the country.
Exactly.
Yeah.
But what's fascinating here is how that revenue translates to profitability.
Right.
We're seeing a non-GAAP gross margin holding incredibly strong at 75.2%.
Which, for anyone who follows traditional manufacturing, sounds like a typo.
It really does.
You expect software margins to be in the 70s or 80s because, replicating code costs nothing. But building physical silicon, packaging it, shipping it, how are they maintaining a 75.2% margin?
It is an absolute masterclass in supply chain execution and pricing power.
Okay, unpack that a bit.
Maintaining mid-70s gross margins at this unprecedented scale, especially when you factor in the rising input costs of raw materials and the severe supply chain constraints we're going to talk about later.
Right.
It means they have an unassailable value proposition. Their customers are willing to pay a massive premium because the alternative, falling behind in the AI arms race, is viewed as an existential threat to their businesses.
I want to dig into that demand side because the philosophy driving this, and this is something we're seeing echoed at the very top of the industry right now, is this mantra that computing has changed.
Computing is fundamentally changed.
I want to translate that for you, the listener. What does it actually mean when industry leaders say CapEx isn't just about buying computers anymore, but about building AI factories?
It requires a complete mental shift in how we view technology infrastructure. Historically, capital expenditure in the tech sector meant refreshing your server racks every 3 to 5 years so your databases would run a little faster.
Or your web pages would load a fraction of a second quicker.
Exactly. You'd see maybe 300 billion to 400 billion spent globally on this traditional IT infrastructure each year. It was a cost center.
Right. A necessary expense to keep the lights on.
But computing has evolved. We are moving rapidly from generative AI into the era of agentic AI.
Right. And for an audience that tracks this space, we know the difference. Generative AI is the chatbot that writes an email or generates a marketing image. It waits for a human prompt, does one thing, and stops.
It's reactive.
But agentic AI is an entirely different beast.
Precisely. Agentic AI refers to systems that can reason, break down complex goals into subtasks, and execute multi-step workflows completely independently.
Give us a concrete example of what this looks like in practice.
For sure. Under a generative model, a financial analyst might ask an AI to summarize a single earnings report. The human does the heavy lifting of knowing what to ask and what to do with the summary.
But in agentic workflow.
In an agentic workflow, the human says, audit these 50 companies for supply chain vulnerabilities and rebalance our portfolio accordingly.
Wow.
The agentic system independently reads the reports, cross-references them with global shipping data, identifies the risks, writes the trading algorithms, executes the trades, and generates a compliance report. It acts as an autonomous agent.
And doing that requires a fundamentally different physical environment than just hosting a website.
Exactly. And that is why we are seeing the final stage of this evolution, which we are cracking early signs of right now, physical AI.
Physical AI.
This is essentially advanced robotics operating in the real world, powered by these exact same agentic models. To power an economy of autonomous digital agents and physical robots, you aren't just buying a computer.
You're standing up a massive, dedicated factory.
Whose sole raw material is data and electricity, and whose only output is intelligence.
And that intelligence output has a very specific metric now. We aren't just measuring gigahertz or teraflops in a vacuum anymore. The new law of the land is that inference equals revenue.
Yes, inference is the engine of the new economy.
Break down inference for us.
Once an AI model is trained, which takes months and massive amounts of data is deployed, when a user or an autonomous agent asks that model a question or gives it a task, the process of the model calculating the answer is called inference. Every single time a token of text, a line of code, or robotic action is generated, it is instantly monetized. It is the core unit of economic value in 2026.
But here is where we hit the physical wall, and this is crucial for you to understand as you look this space. The physical constraint here is power.
Power is everything right now.
We are looking at data centers that are hard-capped by the local grid. Whether a facility has a limit of 100 megawatts or a massive, sprawling 1 gigawatt campus, you only have so much electricity you can legally and physically draw from the grid.
And 1 gigawatt is not a trivial amount of power.
No, it's not.
That is the output of a standard nuclear reactor. That is enough to power hundreds of thousands of homes. When you hit that hard physical limit of power, the ultimate metric for profitability completely changes.
It isn't just about raw speed anymore.
The critical metric is tokens per watt.
Tokens per watt. So if I own a data center and I can only cool 100 megawatts, my revenue is entirely capped by how efficiently my servers can turn those watts into monetizable AI tokens.
Exactly. The architecture that can generate the most monetizable tokens using the least amount of electricity wins the entire game.
Because if your chips are 20% more power efficient than your competitors,
you literally generate 20% more revenue from the exact same building and the exact same power grid.
That is wild.
That is why the underlying engineering of these systems is under such intense scrutiny.
Okay, here's where it gets really interesting. Let's look under the hood of what's actually driving those tokens per watt metrics right now. We need to look at the data on the new Vera Rubin platform.
The Rubin platform is a beast.
The first thing that stands out, and this is a massive shift from even a few years ago, is that this isn't just a single GPU you plug into a motherboard. The Rubin platform is an entirely integrated 6-component supercomputer system.
It is a profound architectural leap. The industry has realized that the GPU alone is no longer enough. When you look at the Rubin platform, you are looking at a symphony of specialized hardware. You have the Vera CPU, the NVLink 6 switch, the Connect X9 Super NA, the Bluefield 4 DPU, and the Spectrum 6 Ethernet switch, all surrounding the primary GPU architecture.
I want to break this down because throwing around terms like DPU and SuperNAND can start to sound like alphabet soup.
It can.
But each of these pieces solves a very specific, very expensive problem. Let's start with the sheer horsepower. For training AI models, the data shows the Rubin architecture hitting 35 petaflops of performance.
Which is 3.5 times faster than the previous generation, the Blackwell architecture.
And for inference, which is where the actual revenue is generated, it hits 50 petaflops. That's a 5x leap.
Yes.
First of all, how is a 5x generational leap physically possible without violating the laws of thermodynamics?
A significant portion of that leap comes down to a fundamental reimagining of how the system handles math. The Rubin platform introduces deep native support for NVFP4.
Which is an advanced numerical format, right?
Correct. It stands for a 4-bit floating point.
Explain why this matters.
To explain why this matters, we have to look at how traditional computers calculate. Historically, high-performance computing relied on high-precision math, like 64-bit or 32-bit floating point.
Right, because scientific simulations, like predicting the weather or modeling a nuclear reaction, require extreme precision out to dozens of decimal places.
Exactly. But AI doesn't work like that. AI is about pattern recognition. It doesn't need to know the exact mathematical weight of a neural connection out to the 15th decimal place to recognize a picture of a cat.
Or to predict the next word in a sentence.
Right. So by dropping the precision down to 4-bit, you are essentially trading unnecessary accuracy for sheer, blistering speed.
You are massively increasing the arithmetic density of the chip.
You can pack far more calculation units into the same physical space and use significantly less power per calculation.
But here is the engineering catch, right? If you are processing math that fast, you have to feed data to the processor fast enough to keep it busy.
Yes. If the processor finishes its math and has to wait a microsecond for the next batch of data, that processor is sitting idle.
And in the world of 1 gigawatt data centers, idle silicon is burning money.
Burning vast amounts of money.
Which brings us to the memory constraint. And the data shows Rubin tackling this with high bandwidth memory, specifically HBM4. The specs indicate memory bandwidth reaching an astonishing 22 terabytes per second.
22 terabytes per second is a difficult number to even conceptualize.
It really is.
It means you could transfer the entire contents of a massive corporate database or thousands of high-definition feature films in a single second.
How do they physically achieve that?
It requires stacking physical silicon memory dies directly on top of each other and connecting them with microscopic vertical wires called through-silicon vias. It's an engineering marvel.
But the reason it is necessary goes back to that system-level view.
Let's talk about that system-level view. Why are those other components, the switches, the DPUs, the superentities, so critical? Practically speaking, for a company trying to stand up an agentic AI workflow, what is the problem this massive interconnected platform actually solves?
It solves the most expensive problem in modern AI infrastructure, the latency tax.
The latency tax.
When you run advanced AI architectures, the data doesn't just sit in one place. Take a common architecture today, like retrieval augmented generation, or RAG.
This is where the AI doesn't just rely on its training, but actively goes out and searches a secure database for the most up-to-date facts before it formulates an answer.
Exactly. Or look at mixture of experts, or MOE, where a massive AI model is actually composed of dozens of smaller, specialized expert models, and the system dynamically routes your query to the right expert in real time.
In both of these architectures, massive amounts of data have to constantly travel back and forth between different components across hundreds or thousands of servers.
So if your network is acting like a congested highway,
then your incredibly expensive GPU, the engine of your AI factory, sits idle waiting for the data to arrive. That wait time is the latency tax. This is where those other components come in. The Bluefield 4 DPU, the data processing unit, is specifically designed to handle the massive overhead of moving data, offloading that burden entirely from the main CPU.
And the Super NICs.
The ConnectX-9 Super NIC and the NVLink switches act like a dedicated, frictionless high-speed rail network directly between the chips. By co-designing all 6 components to communicate flawlessly with near-zero latency, the Rubin platform effectively eliminates the traffic jams.
And the economic result of eliminating that latency tax is the real headline here. The data indicates that this architecture drives the cost of AI inference down by a factor of 10.
A 10x reduction.
A 10x reduction in cost for the foundational building block of the new economy is industry-altering.
It changes the math on what AI use cases are financially viable. If a complex agentic workflow used to cost $1 per execution, it might not be viable for a consumer application. But at 10 cents, suddenly, it can be deployed to billions of users.
That is massive.
Yeah.
But as dominant as this architecture appears, they aren't the only players on the board. Let's pull back and look at the strategic chessboard here, because there is serious competition aggressively ramping up.
Oh, absolutely. The competition is fierce.
We are tracking data on the MI400 series rolling out in 2026, with the next generation MI500 slated for 2027. And this isn't just hypothetical competition existing on a roadmap.
No, it's very real.
There is a confirmed, highly visible deal where a major social media parent company is utilizing up to 6 gigawatts of these alternative AI chips to power their infrastructure.
That 6 gigawatt figure is staggering.
It really is. I mean, we just talked about how 1 gigawatt is a nuclear reactor. 6 gigawatts is the power consumption of several mid-sized cities. What on earth is a social media company doing with that much compute power?
They are essentially trying to build a real-time, personalized AI engine for every single user on the planet.
Wow.
Whether that is generating immersive, real-time video feeds or creating individualized, highly complex recommendation algorithms that operate instantaneously, the compute requirements are nearly infinite.
But more importantly, that 6 gigawatt deal highlights a crucial dynamic in the market.
The sheer desperation and scale of the hyperscalers. The massive cloud providers and tech giants need to secure compute capacity. They are willing to heavily invest in alternative vendors simply to ensure they have multiple supply chains and leverage in pricing.
And it's not just direct merchant competitors selling chips, right?
Right.
We have to look at the hyperscalers themselves aggressively developing custom silicon.
Right.
We are seeing massive deployments of specialized chips like TPUs and Trainium, which are designed specifically for their own internal workloads. Plus, you have highly specialized, incredibly well-funded, fast inference startups entering the fray.
The logic for the hyperscalers is sound. If you are running an AI model that does one specific thing, say, routing ad inventory or filtering content, and you run it billions of times a day, building a custom chip that does only that one thing can be highly cost-effective in the long run.
Even if it lacks the versatility of a general-purpose GPU.
Exactly.
Okay, so I want to challenge this narrative a bit. If you have the biggest companies in the world throwing tens of billions of dollars at alternative merchant silicon, designing their own custom chips, and backing specialized startups, why does the market currently view the dominant hardware player as having such an unassailable lead? Are the Rubin specs really that much better that no one can catch up?
The specs are incredible.
Yeah.
But if we connect this to the bigger picture, the true moat isn't actually the silicon itself.
It's not the hardware.
No. Silicon can eventually be reverse engineered or matched by a determined competitor with enough capital. The true moat is the software layer and the extreme level of co-design across the entire ecosystem.
You're talking at the CUDA platform.
Yes. For almost 2 decades, they have been building out a proprietary software platform that allows developers to easily write code that runs on these parallel processing chips.
That's ubiquitous.
Millions of developers are trained on it, and the entire ecosystem of AI research and deployment relies on its libraries. It is essentially the operating system of the AI revolution.
So even if you build a faster chip,
You can build a chip that is theoretically faster on paper, but if developers have to spend months rewriting their code to run on it, they won't buy it.
right?
The hardware, without the deeply ingrained software ecosystem, is like a Formula One car without a steering wheel. It has immense power, but you can't drive it.
It's the ultimate walled garden, similar to what we've seen in consumer tech, but applied to industrial-scale high-performance computing, and we're seeing them actively protect and enhance that fast inference ecosystem. We noted the strategic acquisition of specific acceleration architectures, like the integration of Grok-like technology. They aren't just resting on their laurels, they are buying the specialized architectures that could threaten them and integrating them directly into their own software stack.
Exactly. But there is another dimension to this strategic chessboard that we cannot ignore, and that is the geopolitical reality. There is a literal global race for AI supremacy playing out right now, and hardware is the primary weapon.
We're looking at data showing that export restrictions completely zeroed out revenue from certain critical nations for a period of time.
Yes, because the concept of sovereign compute has rapidly become a macroeconomic reality.
Sovereign compute, let's dig into that.
Nations have looked at the capabilities of agentic AI and realized that relying on foreign clouds or foreign infrastructure for their primary intelligence engines is a massive national security risk.
Of course it is.
They want their own data centers, running their own localized models, trained on their own cultural and economic data.
So the demand isn't just coming from tech companies, it's coming from nation states.
Entire governments are acting like hyperscalers. Now, while those strict export controls did cause sudden disruptions in revenue channels, the data indicates that recent intensive lobbying efforts have led to somewhat loosened controls.
Allowing specific, slightly detuned architectures to be sold globally.
Right. But the critical takeaway for you as an observer of this space is the emergence of what the industry is calling neoclouds.
Okay, let's unpack that term. What is a neocloud?
A neocloud is a specialized, heavily funded cloud provider whose entire business model is securing first access to the newest, most advanced AI chips, like the Rubin platform, and renting out that sheer horsepower.
So they aren't trying to offer email hosting or basic web servers?
No, they are pure-play AI infrastructure providers. The economic advantage of being the first to deploy a 50 petaflop system is so vast that it creates a compounding lead.
Because everyone wants the fastest compute.
If a neocloud gets the hardware 6 months before a traditional cloud provider, the biggest AI labs will flock to them, granting them the capital to buy the next generation of hardware even faster.
Okay, let's unpack this. Because whenever you hear phrases like compounding leads, industrial revolutions, and we're casually discussing companies trading at multi-trillion-dollar valuations, a very loud alarm bell starts ringing for a lot of people.
Oh, I know the alarm bell you're talking about.
Especially anyone who is investing or working in tech around the turn of the millennium. The obvious question, the anxiety hanging over all of this data is this the year 2000 all over again? Are we looking at a massive dot-com bubble in the AI hardware space?
It is the most common and frankly the most understandable fear in the market right now.
Mm-hmm.
When valuations detach from historical norms, human psychology defaults to the most recent traumatic comparison, which is the dot-com crash.
Naturally.
But when we look objectively at the underlying financial data, the bubble theory starts to dismantle itself pretty quickly.
Let's do the comparison. Walk us through the peak of the dot-com bubble versus today.
In March 2000, the absolute darling of the network infrastructure, Boom. The company providing the routers and switches that literally built the early internet reached its peak valuation.
Right.
At that moment, it was trading at an astronomical 472 times its earnings.
472 times, meaning if the company's profits never grew, it would take 472 years to earn back its valuation.
Exactly. It was a valuation based entirely on pure, unadulterated speculation about what the internet might become decades in the future, completely divorced from the actual cash flows of the present.
So contrast that with today.
Let's look at the current valuations for the leading AI hardware provider in early 2026. Despite the massive run-up in stock price, we are seeing a trailing price-to-earnings ratio of around 37.13.
That is a massive difference. 37 is high for a legacy manufacturer, but for a hyper-growth tech company, it's almost grounded.
It is entirely grounded in reality. And when you factor in projected growth, the forward PE is sitting at just 23x.
But wait, let me push back on that. A forward PE of 23 relies entirely on the assumption that those massive earnings projections actually materialize. If the hyperscalers suddenly stop buying, that forward PE skyrockets, right?
That is the risk with any forward-looking metric. But this is where we have to look at the PEG ratio, the price earnings to growth ratio.
Which factors in the growth rate.
Yes, this metric contextualizes the valuation against the company's actual growth rate. Generally speaking, a PEG ratio under 1.0 is considered undervalued, indicating that the stock price hasn't fully caught up to the explosive growth in earnings.
And what's the PEG ratio here?
The current PEG ratio in this AI hardware space is 0.58x.
0.58. So the growth is actually outstripping the stock price appreciation.
Precisely. That 0.58x PEG ratio is being driven by an expected 60% rise in earnings for this fiscal year alone.
Wow.
The critical difference between the year 2000 and 2026 is that the current valuations, as massive and unprecedented as they are grounded in real, explosive, cash-generating profitability.
In 2000, companies were valued on speculative clicks and eyeballs.
Today, they are valued on billions of dollars of free cash flow generated by selling physical products that are in insatiable demand.
And that real profitability is driving some incredibly bullish outlooks across the financial sector. We're seeing prominent Wall Street targets aggressively pushing the $300 mark, with serious, sober discussions of market capitalizations hitting historic $4 to $5 trillion milestones.
A $5 trillion market cap is a difficult concept to grasp. It represents a concentration of wealth and economic leverage that rivals the GDP of major developed nations.
But as long as the underlying cash flows support the multiples, the math justifies the valuation.
Yes.
But here's where the narrative splinters. We have these amazing fundamentals. We have $62 billion in data center revenue, 75% margins, and a deeply discounted PEG ratio.
Right.
Yet when you look at the short-term stock charts, they are telling a much more complex and, frankly, anxious story. The technicals are fighting the fundamentals.
Right, and this is a vital lesson for anyone analyzing markets. There is often a severe disconnect between the fundamental health of a company and its short-term stock price action.
The chart is essentially a cardiogram of the market's real-time psychology.
And liquidity mechanics, yes.
Yeah.
And right now, that cardiogram is showing a lot of turbulence.
Let's walk through that technical landscape. Despite posting a multi-billion-dollar blowout earnings beat, we've actually seen strong sell signals trigger on several short-term moving averages.
Yeah, we have.
The data shows a critical pivot point right at the $182 to $183 level, with incredibly stiff resistance right above it at $185 to $186. For you listening, what this means is that every time the price tries to push past 186, an overwhelming wave of sellers steps in and physically pushes the price back down.
It's a wall.
Why is the market rejecting these higher prices when the fundamentals are so strong?
To understand the resistance at 186, we have to look at market mechanics, specifically the classic sell the news phenomenon. This isn't driven by fundamental weakness, it's driven by options positioning.
Okay, unpack that, because sell the news gets thrown around a lot. But what is actually happening beneath the surface?
Before a major earnings event for a massive tech company, the options market goes into overdrive. Traders are buying massive amounts of call options, betting the stock will go up.
Right.
To facilitate those trades, market makers and dealers have to sell those options. But market makers don't want to take the directional risk of the stock going up and wiping them out, so they hedge their positions by actively buying the underlying stock.
So the very act of people betting the stock will go up forces the dealers to buy the stock, driving the price up before the earnings even happen.
Exactly. This creates what is known as an options gamma wall. The market becomes perfectly priced for perfection, supported artificially by dealer hedging.
And then the earnings hit.
Once the earnings report is released, the news, the uncertainty vanishes. The implied volatility of the options crushes, the options lose value, and those dealers suddenly have to unwind their massive hedges.
They sell millions of shares of the underlying stock.
Yes. This state of dealer exhaustion forces intense selling pressure, regardless of how good the actual earnings numbers were.
So it's a mechanical unwinding, not a fundamental rejection. But what about the longer-term technical levels? If 186 is the ceiling right now, where's the floor?
The more important level for long-term observers and institutional investors is the structural support at the 200-day simple moving average. The data shows this sitting firmly in the $173 to $177 range.
And the 200-day SMA is essentially the line in the sand for macro trend followers, right? As long as the price is above that line, the long-term trend is still considered intact and bullish.
Precisely. If it breaks decisively below that 173 level, it signals a deeper structural shift in market sentiment. And right now, the data suggests a fascinating divergence in who is buying and who is selling.
What are we seeing?
We are seeing distinct institutional distribution, meaning large hedge funds and mutual funds are taking profits off the table and reducing their exposure.
But retail is doing the opposite.
Yes, retail investors are aggressively accumulating on every dip. Retail sentiment remains overwhelmingly, almost stubbornly bullish at 91.1%.
You have the smart money taking chips off the table while retail money keeps pushing all in. That sets up an incredible technical tug of war.
It really does.
But I want to tie this back to the macro picture. That market hesitation at the 186 level, that institutional distribution, it makes perfect sense when you look away from the digital charts and look at the physical map.
The physical reality.
Yes, those trillion-dollar valuations rely entirely on physical chips moving around the globe, and right now, the physical world is striking back with a vengeance. We need to dramatically shift our focus to the physical constraints. Let's talk about the great bottleneck.
This is the crux of the paradox we introduced at the beginning. The digital world relies entirely, 100%, on the physical world. And right now, we are tracking a severe global memory shortage crisis defining early 2026.
Let's trace this bottleneck to its source. We talked earlier about HBM4, the high bandwidth memory that allows the Rubin platform to hit those massive 22 terabyte per second speeds. Why can't we just build more of it?
Because the manufacturing process is excruciatingly difficult and heavily concentrated. Advanced HBM4 requires stacking delicate silicon dies on top of each other with microscopic precision.
And there are only so many places that can do that.
Exactly. The major semiconductor foundries capable of doing this at scale are primarily located in Taiwan, and they are facing absolute hard capacity constraints. They physically cannot build the machines and the clean rooms fast enough to keep up with the demand from the AI sector.
And this shortage isn't just contained to the massive data centers, is it? It's having a ripple effect.
It is a massive spillage effect. Because foundry space and advanced packaging capacity are finite, the foundries naturally prioritize the massive, ultra-high margin AI chips.
Which means less capacity for everything else.
That means there is drastically less capacity available to manufacture the memory and processing chips for everything else. This shortage is aggressively spilling over into the consumer PC and smartphone markets.
So my next phone or laptop might be delayed or more expensive.
We are looking at a scenario where the basic building blocks of modern consumer electronics are being crowded out by the industrialization of AI.
Which is a supply chain nightmare on its own. But just as the global industry is grappling with finding enough memory chips, a true black swan event materializes.
The geopolitical shock.
We're looking at the raw data coming out of the Middle East, and the situation is rapidly deteriorating. The escalation in military conflict has led to the effective closure of the Strait of Hormuz.
This raises an important question, perhaps the most important question of 2026. What happens when geopolitics forcefully, violently interrupts global tech logistics?
It's chaos.
The Strait of Hormuz is one of the most vital geographic arteries on the planet. The shockwaves of its closure are immediate, brutal, and global.
Let's quantify those shockwaves for the listener, because the numbers are alarming. We're talking about 20% of the world's global seaborne oil immediately stopped in its tracks.
You can't just route around that overnight.
No. Furthermore, in Europe, natural gas futures surged more than 40% almost instantly, driven by the fact that major liquefied natural gas, or LNG, production facilities in the region had to entirely suspend operations due to the security risks.
Energy markets are the bedrock of global manufacturing and logistics. When you see a 40% spike in European natural gas and a massive shock to global oil, the cost of doing business everywhere skyrockets.
But more specifically, this directly and violently hits the tech sector's ability to physically move its products.
Explain the logistics of this. If I'm manufacturing semiconductors in Taiwan and trying to get them to a data center in Europe or the US, how does the Strait of Hormuz closure break that chain?
Highly sensitive, highly valuable technology components like a rack of AI servers worth millions of dollars don't generally travel on slow-moving container ships.
Right, they fly.
They travel via global air cargo networks. But because regional airspace around the conflict zone is restricted and traditional maritime routes through the Red Sea and the Gulf are closed, the entire logistics network has to be rerouted. The data shows that global air cargo capacity has plunged by 18%.
Because planes are having to take massive detours.
Burning more fuel and taking longer to complete a single route, which effectively reduces the total number of planes available globally.
Exactly. And when supply drops 18% overnight while demand remains frantic, prices explode. Emergency air freight costs have absolutely soared, up 400% in a matter of days.
I want to pause on that number. A 400% increase in emergency freight costs breaks almost every financial model out there.
It destroys them.
If you budgeted $50,000 to ship a massive server rack and suddenly it costs $250,000, that eats directly into those 75% gross margins we were marveling at earlier.
It does, and it completely breaks the foundational philosophy of modern manufacturing, just-in-time delivery.
Right. Decades ago, companies shifted away from warehousing millions of spare parts because warehousing is expensive. The modern model relies on components arriving precisely on the day they are needed on the assembly line.
But just in time relies entirely on a stable, predictable geopolitical environment. That model is currently breaking down in real time.
What are we actually seeing on the ground?
We're seeing raw reports of critical supply chain assets literally stranded. High-value EV batteries and crucial 2026 semiconductor shipments are currently sitting in the holds of container ships trapped in the Gulf, unable to move safely.
Stranded capital.
Major global transit hubs, like the Jebel Ali port in Dubai, are facing severe operational disruptions. The physical flow of technology has hit a brick wall.
So what does this all mean? We need to synthesize this. On one side of the world, we have this incredible, almost utopian digital boom. We have 50 petaflop agentic AI systems that can independently reason and solve complex problems, driving trillion-dollar
The
valuations.
digital dream.
But on the other side, that entire digital utopia is violently slamming into a 400% spike in freight costs, massive energy shocks, and stranded shipping containers. How does an investor, or a business leader, or just an informed citizen make sense of this collision?
You have to look at the macro view, specifically the rising risk of a great rotation in the global financial markets.
Let's define the Great Rotation. What rotates and where does it go?
Capital rotates. When energy prices spike 40% and physical logistics stall out, it creates massive inflationary pressure across the entire economy. It threatens corporate profit margins because it suddenly costs much more to manufacture and ship goods.
Right.
Historically, when the market faces persistent inflation and energy constraints, massive amounts of institutional capital rotate away from high-beta mega-cap technology stocks.
Meaning, even if the tech company's fundamentals are flawless, even if they are still selling every AI chip, they can make the big funds pull their money out of tech because the broader economic environment is getting hostile to growth multiples.
Exactly. They seek safety in defensive or cyclical sectors, like energy, utilities, or consumer staples, that perform much better in a high-inflation environment.
It makes sense.
A forward PE of 23x looks incredibly attractive when inflation is at 2% and logistics are smooth. But if inflation spikes to 6% because oil is trapped in the Middle East, that 23x multiple suddenly looks very risky to a macro portfolio manager.
And it's not just energy and shipping constraints adding friction. We are also tracking new trade dynamics that complicate the picture even further. The data highlights a new 15% trade surcharge being implemented on various imports.
Yet another cost.
That adds a whole new layer of complexity to global supply chains and retail pricing. If a company has to pay 400% more for freight and then gets hit with a 15% tariff on top of it, those costs inevitably get passed down to the end consumer.
They do. And that is where the macro picture gets incredibly muddy. Because despite the threat of those tariffs and the rising logistics costs, we are seeing some fascinating, almost contradictory cross-currents in the domestic economy.
The consumer is holding up.
Consumer spending is showing remarkable resilience. The data indicates that spending is currently being buoyed significantly by higher tax refunds this year, which are up over 14%.
So the consumer has a bit of a buffer, at least temporarily, from the supply chain shocks.
For now, yes. But the bottom line for you, the listener, as you try to navigate the complexities of 2026, requires a fundamental shift in perspective.
Which is what, exactly?
The realization that investing in, tracking, or utilizing AI is no longer just a digital exercise. It's no longer just about understanding software code, or the architecture of large language models, or the capabilities of the cloud.
It's all physical.
The digital realm is intimately, vulnerably, and inextricably tied to the physical world. Your AI strategy, your tech portfolio, is entirely dependent on the security of global shipping lanes, the output of memory fabrication plants in Taiwan, and the stability of global energy grids.
Yeah.
You cannot analyze the digital future without understanding the physical present.
It has been an incredible journey to trace today. We started this deep dive looking at the microscopic architecture of the Vera Rubin platform. We marveled at 50 petaflop processing speeds, 4-bit floating point math, and agentic algorithms that can reason and execute tasks entirely independently.
Utopian tech.
And yet, tracing the reality of that technology led us directly to looking at massive container ships stalled in the Middle East, the capacity limits of Taiwanese clean rooms, and the volatile price of seaborne oil.
It leaves us with a deep, lingering concept to explore on our own. We are in a frantic, globally coordinated race to build super intelligent agentic AI in the cloud. We are pouring trillions of dollars into these systems with the hope that they will manage our workflows, cure diseases, and optimize our global industries.
Yes.
Yet as we build this 21st century digital intelligence, our greatest vulnerabilities remain the physical 20th century choke points of the world: narrow shipping lanes, copper wires, and traditional power plants.
That makes you wonder.
Exactly. Will the ultimate definitive test of agentic AI be its ability to solve the very physical supply chain and global energy crises that are currently threatening to choke its own existence? Can the intelligence we are building physically save the infrastructure it relies on?
That is the multi-trillion-dollar question, and that is exactly why we do this. Thank you for joining us on this deep dive. As always, keep questioning the narrative, stay curious, and keep looking beneath the surface of the headlines. We'll catch you next time.